Having risen 3.8% in September, global equities are down 1% month to date as the fiscal impasse in Washington has dominated markets in recent days. There are currently two fiscal issues in the US which need to be addressed by Congress. Firstly, the US has failed to pass a budget over the last 4 years, and instead, government activities have been carried out under continuing resolutions, which are agreements to fund government departments for a specific period of time or for specific programs. This year, efforts by Republicans to rein in government expenditure by focusing on efforts to remove funding for President Obama's signature piece of legislation, the healthcare plan, have resulted in failure to even pass a continuing resolution, and as a result there has been a partial shutdown of some non-essential government activities. There have been 17 government shutdowns since the mid-1970s, with details of their length and equity market performance during the shutdown shown in this table. The average shutdown has lasted 6 days, with an average equity market fall during the period of -0.8%, with the range of equity market returns being -4.4% to a positive 1.3%. Typically, after the shutdown ends, markets tend to rise and on average have been up 2.8% in the following 3 months. The GDP impact of the shutdown is estimated at approximately 0.1% per week, but is expected to be made up later on as all government employees have previously received full back pay when the shutdown finally ends, as is expected to occur on this occasion. While the shutdown does give rise to disruptions and uncertainty, with the GDP impact over the quarter as a whole expected to be minimal, and on the basis of historic equity market performance during previous shutdowns, the impact on equities should be limited. Probably of greater importance to markets is the second issue relating to the debt ceiling. The debt ceiling refers to the fact that there is an absolute limit to the amount of debt that the US government can raise, which is set by legislation, but it has been raised 74 times since 1962. Republicans are also trying to link any agreement to increase the debt ceiling to cuts in funding for the healthcare plan. The current debt ceiling limit is $16.7 trillion and is expected to be reached on the 17th of October, at which point the US will no longer be able to issue any new debt to fund itself if the ceiling is not raised. It will, however, have about $30 billion of cash balances, which will enable it to function until the end of October. Thereafter, however, it will be unable to pay social benefit payments, salaries and pensions, and coupon payments on debt maturing in November, which would mean the US would technically have defaulted. Failure to raise the debt ceiling could potentially have significant negative consequences for the economy and markets. A requirement to immediately run a balanced budget would lead to a substantial reduction in government spending and reduce GDP by about 4%. A technical default could raise funding costs for the government, corporates and individuals and disrupt financial markets, with the use of Treasury bills as collateral being questioned. Given the significant negative implications of not raising the debt ceiling, it is very unlikely this will be allowed to occur, as neither party will want to be associated with causing such turmoil. As is often the case, we expect that a last-minute political compromise will be reached which resolves the situation and removes the uncertainty which has been overhanging markets. The Fed surprised markets in September by not beginning to taper QE3. It did so given uncertainties relating to the fiscal developments in Washington, the impact of tighter financial conditions on housing and the economy, and the desire to assess further data to judge the sustainability of the recovery. The minutes of the meeting showed most members expected tapering to begin before year-end. Given the uncertainties caused by the political standoff and the fact that many economic releases have been delayed because of the government shutdown, it is possible that tapering might be delayed until January, at which point the Fed should be more confident about the sustainability of the economic recovery. Global bond yields have fallen in recent weeks due to the delay of QE3 tapering and the political uncertainties. We expect yields to rise again towards year-end and into 2014 as reductions in asset purchases finally begin and the global economy continues to improve. Equities remain underpinned by valuations, positive flows and improving fundamentals, and should resume their upward trend once the fiscal impasse in the US, as we expect, is eventually resolved.